So things are becoming more expensive and our salary doesn't seem to be keeping up with the cost of living. A $50 note today can't buy you as many things as it could 10 or 15 years ago, and what we can afford seems to either be dwindling or we just have to save more or save for a longer period of time just to buy those big ticket items. So what is happening to the value of our cash? And what if I tell you that each time someone takes out a loan from the bank, the cash that you hold became a little lower in value than yesterday? Is cash still king? So in today's episode, let's talk about what happens when a bank grants a loan and how that impacts the value of the cash that we hold. And at the end of the episode, I'll also share what Warren Buffett does to make his money work harder for him. Firstly, let's define what is money or cash. Now there are three types of money, M1, M2, M3, which we won't dive into in this episode. The money we're referring to today would be the M1 type, which is an accounting of every note and coin in use or circulating in the economy, whether it be in a person's wallet, a bank teller's drawer, etc. So what happens when a bank grants a loan? So for many of us, banks have always been described as a place where savers would deposit their money into, and from this pool of funds, banks would then lend to borrowers. However, this is not the case in modern-day banking system. Banks nowadays run on a system known as the Fractional Reserve Banking System. Now in this system, banks need only to keep a fraction of the deposits in cash at the country's central bank as a reserve in case there is a mass withdrawal. This fraction determined by the country's central bank is known as the reserve requirement or reserve ratio. So to illustrate this point, say for example, Bank A has $1,000 in deposits and the reserve requirement is 10%. So Bank A has to keep $100 or 10% of the deposits in cash with the central bank and can lend the remaining $900. So during the pandemic in 2020, US Fed reduced the reserve requirement to 0% to encourage spending in order to boost the economy. Now this has led to increased liquidity in the market and the inflation we're experiencing today. Thus, by adjusting the reserve requirement, central banks are able to control the supply of money circulating in the economy. Now, because of the way banks are able to lend more than they hold in deposits, the fractional reserve banking system creates a money multiplier effect, meaning more and more money goes into circulation in the economy. So to illustrate this point, let's take a look at an example. Let's also assume the reserve requirement is 10%. So Alex deposits $1,000 cash into Bank A. Out of $1,000, Bank A needs to ensure there is 10% or $100 in cash kept in the reserve and can lend the remaining $900, which will make its way back into the banking system as deposits. Now this $900 is newly created money that is back circulating. Barry comes along to borrow $900 from Bank A. Bank A lends Barry $900 in the form of a digital bank transfer. Barry then digitally deposits it into Bank B. Bank B receives the deposits of $900 of digital transfer. Out of $900, Bank B has to ensure they have $90 in cash in the reserve and can lend the remaining $810, which again makes its way back into the banking system as deposits. This $810 is new money circulating in the economy again. So Carrie comes along to borrow $810 from Bank B. Bank B lends Carrie $810 in the form of a check. Carrie then deposits it into Bank C. Likewise, Bank C receives a deposit of $810, and out of the $810, Bank C has to ensure they have $81 in cash in the reserve and can lend the remaining $729, which again makes its way back into the banking system as deposits. So this $729 is new money circulating in the economy again. And this goes on not just for millions of people doing banking transactions daily, but also for the multiple banks in every country. So the fractional reserve banking system allows for new money to be created, which means increasing the money in circulation. So how does this impact the value of cash? So as you've seen from the examples previously, a bank creates money whenever it provides a loan. For instance, when I applied for a personal loan, my bank informs me that the loan has been granted. Within a few clicks on the computers, entered my account information, the loan amount was added to my balance in my account. I had more money now. When they granted me the loan, the bank created this money. Likewise, as they grant more and more loans, more and more money is created, meaning more money is circulating back into the economy. Inevitably, with more liquidity, it leads to a weakening in the value of money that we hold over time. So you must be wondering, what can you do to make the best of this situation? While it is important to save cash for rainy days, holding too much money may not give you the best bang for your buck. While we are definitely not advocating consumer debts like personal loans or credit cards, but using a good form of debt to buy assets, example, taking mortgage loans to purchase real estate, can help to hedge against the unavoidable inflation. So a mortgage is also one of the only significant forms of debt with lower interest rates that is secured by a resource that is anticipated to increase in value over time. Although you can refinance your car loan if rates drop, the value of your car decreases quickly during the first few years of ownership. In fact, billionaire investor Warren Buffett has called a 30-year mortgage the best instrument in the world because it has the ability to be refinanced. When Warren Buffett bought his home for $150,000 in 1971, he shared that he put around $30,000 of down payment on the property and borrowed the rest. And this is what he said: "I thought I could probably do better with the money than have it be an all-equity purchase of the house." And he didn't just stop there. Warren Buffett ended up buying shares of Berkshire Hathaway with the money he could have used to pay off the home fully. So as a result, he ended up growing the $120,000 that he would have paid in cash for the home into a whopping $750 million because the shares he bought had gone up so much in value. So thank you for listening to the end. I hope you found this useful, and I'll see you in the next episode.